Hello. Do you know how the bank first made money? Let's go learn from step by step. Banks make money in many different ways. The main way is by lending money to individuals, businesses, and governments, and charging higher interest on loans than they pay to depositors, which is called the interest margin. They pay a small interest on savings accounts or fixed deposits, while charging higher interest on mortgages, personal loans, business loans, and credit cards. Banks also earn money from fees for account maintenance, ATM withdrawals, overdrafts, wire transfers, and late payments. Credit cards are a major source of profit because banks charge interest, annual fees, and penalties for late payments. Banks invest in stocks, bonds, government securities, corporate bonds, real estate, and other financial products, earning interest, dividends, and capital gains. They offer investment banking, wealth management, financial advisory, and brokerage services, earning commissions and service fees. Many banks sell insurance products like life, health, and property insurance and earn commissions on these policies. Foreign exchange services allow banks to profit from currency conversions and fluctuations in exchange rates. Some banks also trade commodities, currencies, and securities to earn extra profits. 1. Securitization and the originate-to-distribute model. Modern banks often don't keep loans on their books. Through a process called securitization, a bank will bundle thousands of mortgages or car loans into a single financial product called a mortgage-backed security, MBS. They then sell this bundle to global investors. This allows the bank to get its cash back immediately, collect a massive processing fee, and then use that same cash to issue new loans. This cycle allows a bank to grow far beyond the actual cash it holds in its vaults. 2. The derivatives market and hedging. Banks operate in the massive derivatives market, which is valued in the hundreds of trillions of dollars. They act as counterparties for businesses that want to hedge risk. For example, an airline might pay a bank to lock in fuel prices for the next 5 years. The bank uses complex mathematical algorithms to manage this risk, charging a premium for the protection. Furthermore, banks participate in credit default swaps, CDS, which are essentially insurance policies on the debt of other companies or even countries. 3. Central bank arbitrage and quantitative easing. Large commercial banks have a unique relationship with central banks, like the Federal Reserve or the ECB. During periods of quantitative easing, central banks buy assets from private banks, flooding them with excess reserves. Banks can then use these reserves to purchase government bonds or lend them back to the central bank for a guaranteed, though small, interest rate. This risk-free profit is a major part of how the world's largest banks stayed profitable during recent economic crises. 4. Correspondent banking and global rails. Banks earn significant invisible revenue through the global payment rails, like SWIFT. Because small banks in developing nations cannot directly access every currency, they must maintain Nostro and Vostro accounts with global custodian banks, like BNY Mellon or JP Morgan. These giant banks charge fees for every international transaction that passes through their systems, effectively acting as the digital infrastructure for the entire planet's trade. 5. Fractional reserve versus capital adequacy, the safety net. To prevent the system from collapsing, banks must follow Basel III Accords. These are international rules that dictate how much Tier 1 capital, the highest quality equity, a bank must hold relative to its risk-weighted assets. If a bank wants to lend to a risky startup, it must hold more of its own capital in reserve than if it were lending to a stable government. This constant balancing act between leverage, using borrowed money to make more money, and liquidity is the most difficult part of the banking business. 6. the rise of shadow banking and fintech. Finally, the business has moved into the shadow banking sector, where non-bank financial institutions perform bank-like functions without the same regulations. Large banks now partner with or buy fintech companies to utilize big data and AI. These tools allow banks to perform psychometric credit scoring, predicting your ability to pay back a loan not just by your income, but by your digital behavior, spending patterns, and even social connections. Banks lend money to other banks or financial institutions at short-term interest rates and make profit from the difference. They use economies of scale, meaning handling large amounts of money reduces costs and increases efficiency.